Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Thursday, November 27th, 2025, and we've got a really interesting batch of AI-generated insights for you today, compiled from a significant volume of user posts we analyzed from yesterday.
That's right, Ethan. Our systems flagged quite a few different stocks, and I have to say, the overall market commentary is a real mixed bag. We're seeing everything from exciting growth potential being highlighted to some serious red flags that demand caution.
Absolutely. Today, we're going to dive into the specifics, highlighting the stocks that captured the most attention and dissecting what the community and the data are saying. So, let's jump right in, shall we?
Let's start with Robinhood. It's been a bit of a roller coaster for them in the past, with quite a few stay away ratings from us. What's the chatter telling us today, Ethan?
Well, Brooke, the sentiment around Hood is overwhelmingly bullish right now, and for good reason. Users are celebrating some fantastic short-term trading profits, with one post even talking about $1.8 million in profits this week from Hood options. The talk is all about Hood calls back from the dead, signaling a strong recovery. People are really confident in its long-term value too, calling it a long-term hold after what they saw as a ridiculous beatdown. Plus, the news is buzzing about Hood's aggressive push into prediction markets through partnerships and acquisitions, which is a major growth driver. Their revenue growth is an impressive 100%, and they have a fantastic net profit margin of over 52%. That really supports the outstanding earnings comments we're seeing.
Okay, Ethan, I hear the excitement, but let's pump the brakes just a bit. While those short-term gains sound great, my KPIs are flashing some serious warning signs for the longer haul. Hood has an incredibly high price-to-earnings ratio, suggesting a lot of future growth is already priced in. And that beta, sitting at 2.423, confirms this is a highly volatile stock. Craziest trading week indeed, which is great for option traders, but a huge risk for traditional investors. Most concerning is their debt-to-equity ratio, a staggering 188.944. That's a lot of leverage, and it introduces substantial financial risk. While the expansion into prediction markets is intriguing, that kind of debt and volatility doesn't just disappear with good news. We've rated Hood stay away multiple times in the past, most recently on November 21st.
I get your point on the risk, Brooke, but these strategic moves into new markets, coupled with that phenomenal revenue growth and profit margin, really do have the potential to grow into that valuation. The company is actively building new streams of income, which could improve those debt metrics over time as profits roll in. I think for someone with a higher risk tolerance looking for growth, the current momentum and strategic direction are very compelling.
It's a speculative growth story for sure, but the debt and volatility mean it's not for the faint of heart. Given the significant upside potential highlighted by the news and the strong underlying profitability, but also the serious financial leverage and high volatility, I think we have to classify this as a cautious buy. It's an upgrade from our previous stay away, but with strong caveats.
Fair enough. Now, moving on to Strategy Inc., MSTR, a familiar name in the crypto space. But what's the latest?
Ethan, the latest is a resounding ouch. The sentiment around MSTR is overwhelmingly bearish. One user's post, "I'm cooked, need MSTR to hit 320 to break even," really captures the mood. Our sentiment score is a very bearish -8. The stock's current price is 175.64, which is alarmingly close to its 52-week low of 166.01 and a steep drop from its 52-week high of 457.22. People are calling it an expensive BTC wrapper run by a charlatan, and that its core business intelligence product is shitty.
Wow, those are some strong words. But MSTR has always been a high conviction play for some. Tying into the future of Bitcoin, some might see its current low price as an opportunity, especially if they believe in a long-term crypto rebound or the potential of the upcoming Bitcoin halving cycles, which can be future catalysts. Even Jim Chanos, a legendary short seller, reportedly closed his MSTR trade, which could be seen as a positive.
I appreciate the optimistic outlook, Ethan, but the KPIs here are screaming caution. That debt to equity ratio is a very high 14.147, showing significant reliance on debt. News specifically states that Strategy's interest costs are about to rise, which will put even more pressure on their finances. Its beta is 3.37, making it extremely volatile, and their revenue growth is a paltry 0.109. The news that Michael Saylor's Strategy is now worth less than the Bitcoin it owns fundamentally questions the entire premise of the investment. We rated MSTR as a speculative gamble yesterday, November 26th, but this new data pushes it further into risky territory. This is a clear stay away.
Understood. Next up is New Fortress Energy, NFE. What's unfolding there? Well, this one's fascinating, Brooke. The primary discussion points towards a potential short squeeze for NFE. We're seeing exceptionally high short interest, with over 54% of the float shorted, and shares available to borrow are critically low. Users are calling it a very high-risk, high-reward play. There are massive potential catalysts on the horizon, like the renegotiated Puerto Rico contract, a 7-year, $4 billion deal, or a successful debt restructuring. Bondholders have even agreed to forbearance until March 2026, which buys the company crucial time. This sets the stage for a dramatic upward swing if any of these positive events materialize, you know?
I get your point, Ethan, but the company's fundamentals are in severe distress. NFE's debt-to-equity ratio is an astronomical 827.941, indicating extreme overleverage. Their revenue growth is negative at negative 0.421, net profit margin is negative 0.733, and EPS is a dismal negative 5.36. The most critical piece of news, which can't be overstated, is that New Fortress Energy itself reports substantial doubt over ability to continue as going concern. That's a company-issued warning that their very survival is in question. We've given NFE speculative gamble ratings quite recently, on November 21st, but this new going concern report changes everything. The risk of total loss is simply too high. This is a definitive stay away.
All right, that makes the picture very clear. Finally, let's look at Rigetti Computing, RGTI. What's the latest with this quantum computing play?
With RGT, the community sentiment is quite bearish even. One post highlighted a significant profit from RGT calls, but the user explicitly attributed it to luck, not company strength. Comments were quick to dismiss it as gambling and predicted a return to losses, saying, "Can't wait for the follow-up 37 to 1,000 to 37 post." The stock has shown extreme volatility with a beta of 1.647, and its price has been all over the place, currently at 25.57, well below its 52-week high of 58.52.
You're right about the volatility, Brooke, but we're talking about quantum computing here. It's a cutting-edge field with immense future potential. Benchmark has actually assigned a buy rating to RGTI, and there's news about renewed National Quantum Initiative funding, which could boost government sales. While some gains might be speculative, these are real catalysts for a company in an emerging sector. With the right breakthroughs, those negative KPIs could flip quickly.
That's a big if, Ethan. My KPIs show a company bleeding money. They have zero net profit margin, negative EPS of negative 1.43, and negative revenue growth of negative 0.181. They're simply not profitable, and their sales are shrinking. Add to that a very high price-to-book ratio of 22.37, which suggests it's significantly overvalued relative to its book value, especially for an unprofitable company. Their debt to equity is also quite high at 2.043. Even with the NQI funding, the company's current financial health is dire. We've consistently rated RGTI as stay away for a long time, and nothing in this new data suggests a fundamental improvement. It remains a stay away.
All right, quite the interesting day, Brooke, with some truly wild swings in sentiment and data. So, for our listeners looking for where to focus their research, here's our compiled list for deeper analysis from today's AI-generated insights. Investigate as buy. None. Investigate as cautious buy. Robinhood Markets, RGTI. Investigate as speculative gamble. Strategy Inc., MSTR.
And that wraps up another episode of the Daily Hunt for Multi-Baggers. Before we sign off, remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
That's right. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in. We'll be back tomorrow with more AI-generated insights from the market.
Happy hunting, everyone!